Hey, you guys, it's Jennifer Reynolds. We are going to talk about how to calculate interest and kind of why. So, in this chapter, we're the company that is loaning someone money. Why would a company loan money? Can you stop the video and think about that and answer? Okay, so one big reason is that might be the company's main business. So, if you look at a bank, that's what they do to earn revenue. They loan money, the person pays the money back with interest, and the interest is the revenue. But companies may loan money possibly to customers who need to finance something out. Take a car dealership. They want to sell a car, but a second stream of revenue for them could be to offer financing for that vehicle, which ultimately helps them sell more cars, right? So, one thing you need to make sure you are aware of is some new terms in this chapter that maybe you've heard of and didn't really know what they mean. One is principal versus interest. So, principal just means the face value of the loan, how much we initially took out, right? In this problem, I'm going to have ABC Company loans another company $10,000. There's an interest rate attached, but the principal amount is the $10,000. The interest is what XYZ is going to have to pay back in addition to the $10,000. Another account we're going to talk about in this chapter is notes receivable versus accounts receivable. They're both assets. They're both the company, in this case, ABC Company, would record a notes receivable saying XYZ owes us something. So, what's the difference in a notes and accounts receivable? Generally, a notes receivable is a little more formal. There's generally interest involved. It's usually for a longer period of time, whereas accounts receivable is more like we sold some goods on account. Say Nike sold some tennis shoes to Dick's Sporting Goods on account. Nike would record an accounts receivable and usually say you've got like 30, 45, maybe 60 days to pay us back. There's usually not interest involved. So again, they're both an asset. Notes receivable is what we're focusing on in this chapter because it's going to be a little bit longer term and there's going to be interest attached. Okay, so we've got ABC loaning XYZ $10,000 for 6 months at 12% interest. You hopefully remember from high school a little formula like this: principal times rate times time. That's all we're going to be doing here. But because we're accounting, we have to make sure that things are recorded in the proper period. So we're going to break this down a little more. Principal, of course, is 10,000. Rate is 12%. Time depends on how long. In this case, it's 6 months. So we would say 6 divided by 12. So in total, 10,000 times 12% would be $1,200. That would be for an entire year times 6/12 or divided in half would be $600. In total, XYZ is going to have to pay ABC $600 for interest. But that's not all we need to figure out in accounting, right? We have to figure out again which financial statement to put this on, where our interest revenue goes versus where our notes receivable goes, interest receivable, that kind of thing. All right. So I am going to work this a couple of different ways. In the first example, we need to know when this loan is made. So in the first example, I'm going to say this loan was made on January 1st. So what would ABC Company need to record? On January 1st, they would just say a debit to notes receivable, right? And a credit to cash because they gave XYZ some cash. Easy. And we go, okay, that loan tells us that the principal and the interest is due at the very end of the loan. This isn't like a car payment where you pay a little bit back each month. It says XYZ isn't going to touch this until the very end of the 6 months. So January goes by, February, March, April, May, June, July 1st is when XYZ pays the money back. Since we're looking at receivables, what would ABC record when they get the money back? Well, first of all, how much money are they getting back? 10,000 plus the $600, right? So that's easy. Always start with cash. ABC goes, we got some cash. Cash of $10,600. But what is the rest of this? Well, remember how we debited notes receivable for just 10 grand? That means our credit can only be for 10 grand. to clear out that T account. But that journal entry doesn't balance. I need a $600 credit here to make it balance. Where did that other $600 come from? Oh, that's the revenue we earned. So we're ABC, we would record interest revenue of $600 there. Okay, that's easy. Let's change it up a little bit and make it a little more difficult. Not for the sake of being difficult, but because this is what happens in real life. Now, instead of ABC making the loan on January 1st, they make the loan on November 1st. So when is XYZ going to pay the loan back? Well, the loan's going to be outstanding November, December, 2 months during year one, and then January, February, March, and April, 4 months of year two. And they would pay back on May 1st. Okay, quick and easy quiz. How much total interest is XYZ going to have to pay ABC? Still $600, right? No matter what day we make the loan on, if it's a 6-month loan, it's still going to be $600 in interest. But now with accounting, with our income statements, we record things one period at a time. So remember, these are our temporary accounts so that we can kind of look back and go, how'd we do in year one? How'd we do in year two? And compare our years. So now that you know this, what amount would ABC record as interest revenue in year one versus year two? Well, they earned $100 of interest here and $100 of interest here, and then another 100, so $400 in year two. So $200 in year one, $400 in year two. And hopefully that's easy to see. The problem is just when you get to journal entries, sometimes students get confused. But look, there's still the same $600 of interest revenue we're earning. It's just we've got to split this up, and we're going to put 200 of that on year one's income statement for November and December, and 400 of that on year two's income statement. That's all. But what's going to happen at the end of year one? What do we do at the end of a period? We make adjusting entries so that our financial statements are up to date and they're giving a true picture of what's going on in the company. What kind of adjusting entry would ABC need to make in this case? So let me see where I'm going to write that. I guess I'll erase my problem over here. The same entry happened on the day they made the loan that we've already discussed. They record a note receivable of $10,000 and they record cash that they gave XYZ of $10,000. December 31st rolls around and you go, but wait, Jennifer, they didn't accept any interest. Remember, that company's not going to pay us back until next May. So why do we make an entry? Well, remember, in accrual accounting, we record revenue as it's earned, whether we got the money or not. Has ABC earned any revenue? You betcha. The day that we gave XYZ some money, that interest clock started running. 1 day's interest, 2 days interest, 3 days interest, 4 days interest. So it's now the end of December. They have earned 2 months worth of interest, which is how much? $200. So they go ahead and record, our journal entry has to record this revenue so that it will show up on our income statement. So interest revenue of $200. What is my debit going to be then? What's the other part of this entry? The other part is going to be a receivable because the problem told us XYZ isn't going to pay us anything back until May, right? So we have not a note receivable, but interest receivable, still an asset on the balance sheet. And now our financial statements are up to date. We show on the balance sheet, not only does someone owe us 10 grand, now as of today, there was another $200. And then we correctly report on the income statement that we have earned $200. Okay, fast forward until the next year, and it's May 1st, and this company, XYZ, is paying us back. what would we record? I guess I can still leave that there. What would we record on May 1st? Well, again, how much cash does XYZ have to give us? Not just the 400 of interest, all 600, right? They haven't paid us a dime. So they've got to give us the 10 grand they owed us plus all $600 of interest. So our cash goes 10.6. And then what happens? Well, we reduce this notes receivable. I'm like, oh, we don't have that anymore. They just gave it to us by the 10,000. We reduce this interest receivable of 200 because they gave us that also. 200. So down, down. What else? Now we've earned 4 more months of revenue for year 2. So I guess I should say interest receivable for that one, interest revenue for this one. Up. So there's my $400 of revenue that goes on year 2's income statement. And the rest of the money just went to pay off what XYZ owed us for last year. Okay, I will make another video on interest expense as we focus on that in a later chapter.